Welcome to the Real Estate Research Center's Mid-Year Economic Outlook update. We're here this morning or today to look at what's going on in the economy and see if we can make some sense out of it, of where we've come from and where we might be going. No secret that for the last 18 months or so, the Fed has been extremely aggressive at raising interest rates to fight inflation that spiraled up to near double-digit rates here about a year and a half ago. The primary focus of the Fed continues to be to fight inflation. They continue to announce that they are going to try to get it down to around the 2% level. From currently, it's around 3.3% as of the latest readings. And then as a result, we've had continuous increases in the federal funds rate, increasing general interest rates, and these have been creating limitations and slowing down the overall economy in terms of general business, housing, business investment, commercial real estate, and so forth. One of the perplexing issues of the day to economists is that we have now what's called an inverted yield curve. Basically, it means short-term rates are higher than long-term rates. And in fact, the 3-month Treasury yield is at about 5.8%, where the 10-year Treasury is about 4.25%. So you can see there's a big difference there. It's actually cheaper to borrow money in the long run or for a longer term than it is for short term in terms of the interest rate. The significance of that is that the inverted yield curve generally has preceded recessions by anywhere from about 12 to 18 months. We've been in an inverted yield curve situation, though, for more than a year. So we're coming up on that time where if it's going to happen, it's probably going to happen pretty soon. And a lot of economists, the consensus seems to be that to expect a recession probably the first quarter of 2024. Now, I need to tell you that consensus has moved and shifted out from one quarter to the next to the last 3 quarters. So it's kind of interesting. We'll have to wait and see. The alternative is that employment and wages and income, though, continue to still be strong. Even retail spending and consumer spending continue to be fairly good. And that has been keeping the economy moving and keeping us out of the recession. So consumer spending, while expected to slow down, we'll just have to wait and see. Here's what it looks like in terms of the interest rates. The green bar that you see is the short-term overnight bank lending rates, the federal funds rate. That's the rate the Fed actually controls the most, and it sets its target for. And what you can see there in the chart is clearly how significantly higher, at about 5.5%, it is than the 10-year Treasury rate, which right now is hovering right around 4 or 4.25%. And that's a very interesting kind of phenomenon. What else is going on is that 30-year fixed mortgage rate for buying a home is now approaching, and in fact, as of the middle of August, has exceeded the 7% level. And August 24th numbers, it was right at 7.2%. So the housing market is experiencing the slowdown that one would expect with higher interest rates affecting people's ability to buy a house, which affects the general economy and affects everything else. So we'll have to see. Here's one of the big things, though. Personal consumption expenditures, which incidentally accounts for about 2/3 of GDP. You can see how since January of 2021 has just exploded. One of the reasons for that explosion has been that consumers and households saved an estimated $2.2 to $3 trillion more than they would have normally under normal circumstances. They couldn't spend the money during COVID, couldn't do anything. Then the federal government was giving out subsidies and so forth to try to overcome the downturn from the pandemic. And so what has been happening for the last year and a half, a lot of that money has found its way into the economy, being spent, and it's no surprise with that kind of a significant increase in consumption spending, that we wouldn't have seen inflation. Now, the good news is that total personal savings have declined from roughly about $3 trillion in mid-2020 to about $650 billion in mid-2022, or by the end of 2022, which means that a lot of that money now has already been churned through the economy and been spent in personal consumption. Incomes have been going up. This is the other part of the equation, that generally you have a recession, you generally get low employment, you get a higher unemployment, and you get low incomes. We've been doing just the opposite. Employment is going up, unemployment has been going down, and personal income, both in total and in disposable personal income, the orange line there, have been going up. And we can see Texas has even done better than the nation. By fourth quarter 2022, U.S. total personal income had increased a little over 5.5%. Texas's total personal income had increased over 7.5%. So Texas has been more than maintaining pace with the U.S. economy. It has actually been outpacing the economy. Employment, as I mentioned, has been strong and continues strong. Unemployment at about 3.6%. And what you can see here is that by September of 2022, we had recovered all of those jobs that we lost during the pandemic. We got back up to break even, if you will, and start on recovery. The interesting part of this is the economy slowdown of the last 6 months or 9 months. You can see that orange line tailing off upwards to the right and not going up toward the trend line of where we might have expected employment to go. It'll still take a while to get back up to the trend line if we continue on the current course that we're on. Texas, on the other hand, GDP has been growing. Last year, GDP grew over 14% on the percent change from a year ago. You can see, though, that was because 2020, 2021 were down years because of the pandemic, and so naturally you would get a bigger percent increase, but it's extremely large. Texas has done very, very well. The Dallas Fed's Texas indicators, leading indicator, has been very good. It's been constant. It's been flat for about the last 6 months, plus or minus a little bit, but it still tells us that Texas's economy is still on good forward trend. This is further evidenced by looking at our employment growth. Unlike the national growth, our employment growth in Texas for non-farm jobs has not only recovered from what it was pre-pandemic, but now is even in excess of where the trend would have been if we, based on the trend, upward trend extrapolation of where we might have been or could have been without COVID and without the pandemic, which is very good news indeed for Texas. So what we see is Texas in general is ahead of the nation. GDP growth has been ahead. Jobs fully recovered and more, and continuing to grow. We were expecting some growth, job growth this year of about 3.3% for 2023 as compared to 5.8 last year. Yeah, it's a little bit lower, but 3.3% growth is still going to be very good growth. Income growth is going to follow that job growth. Spending by both consumers and business is holding up. It's probably going to slow down a little bit as a lot of that excess savings that was accumulated during the pandemic is used up. The energy sector is contributing to economic growth, a little lesser effect than 30, 40, 50 years ago perhaps, but nevertheless, with oil prices hovering around $80 a barrel, and with expectations that that may go up over the course of the next year or so, we'll see some growth and some contribution there. Distribution, biomed, two of the major areas of growth, not the only areas, but two of the major ones in the state. And then last but not least, of course, the main kicker, population growth. About 400,000 people a year, at least for the last 2 years, have been coming to Texas. They continue to come to Texas. Job opportunities, cost of living, and, of course, the best Tex-Mex food in the country. Thank you very much for joining us. We've really enjoyed putting this together. If you would like more information or have questions, please look online at our website where you can find more about what we're talking about. Thank you very much.